When will the housing market crash? That is the question nearly every single buyer in the United States is asking following 12 quarters of absurd, never-ending price growth. According to Redfin.com, the average homebuyer housing payment has increased by more than 90% since May 2020. Just 3 years ago, a new buyer could expect to pay around $1,300 a month for the average home. Today, that number has increased to a record high of $2,566 per month. In essence, looking through the prism of overall monthly costs, the housing market has never been more expensive, and week after week, it just gets worse. You don't need to stare at a graph or analyze dozens of data points to spot the obvious. We are clearly in some sort of bubble, and the question on everyone's mind is simple. How will it pop? And when will prices and monthly payments return to the long-term mean? In today's video, we look to answer exactly this, providing a detailed outline on when I think it will happen and what we can expect when it finally does. But first, to lay the foundation for this argument, we need to understand something that is arguably the most important data point in real estate. Supply, which is also known as inventory. Right now, if we look at our current inventory situation, what we see is that we're still well below what was considered normal in the pre-2020 world. According to Alto's research, as we speak, there are around 400,000 single-family homes for sale, which is an improvement compared to years past, but still well below the 800K number we saw in years prior to 2020. Housing supply is surprisingly a highly complex topic that we can talk about for days, but to spare you the math, let's just summarize with this. Supply is still very tight and the number of homes for sale is well below normal. However, something interesting is happening despite this fact. The price growth we should be expecting from this low supply environment is not happening, and this is due to falling demand largely influenced by affordability issues. The market currently finds itself in a battle between tight inventory pushing prices up and affordability pushing prices down. And this battle has now been raging since the Fed decided to raise rates in January of 2022. You can see from nearly every single graph that it was in the months preceding this decision that we saw prices finally begin slowing down and even dropping. From January of that year to October, a normal 30-year mortgage went from 3% to 7%, which caused monthly payments to erupt from $1,650 per month to $2,500 per month just 9 months later. This caused massive affordability issues, slowing demand down in a way that we had not seen since the early 80s. The Fed essentially shot a tranquilizer into an overheated, raging market, and the shot did its job. Things slowed down, but the market didn't collapse. It was still on its legs, not moving. Rates have since stabilized in this narrow 6 to 7% range, and inventory has stopped moving up, essentially staying flat. Many experts, including those at Alto's research, now predict that we will end the year with around 500,000 homes for sale, which is to say that we will end the year at essentially the same levels we started with. Now, with that out of the way, here comes the bad news for all you buyers. With no hope of inventory growth, there is almost no chance that large price declines are coming anytime in the near term. The price action we saw in 2022 simply cannot be replicated unless one of two things happen. But before I reveal this, please take a moment to do one of two things for me. One, hit the like button, and second, hit that subscribe button if you're enjoying the content thus far. This small action greatly affects the performance of this video, and I would greatly appreciate it if you can help me out with this simple gesture. Now back to the video. So as I was saying, there's no hope for a price decline this year unless we get massive changes. This we know because if a crash was coming in the near term, we would already see some growth in the supply data. For example, last year at this time, inventory was rising 4% per week, peaking out in November. But this year, we're not seeing any sort of bump. In fact, inventory is contracting, signaling a tough, competitive summer with little to no price declines. Now with the bad news out of the way, the question is there anything more to add to this reality other than the fact that the crash is essentially canceled? Well, yes, and this is where we begin to talk about 2024. You see, it is true that prices will likely stay relatively strong going into the winter, but the story of next year starts to get really interesting when we begin to examine recession data. We know that the US economy is slowing down. Sure, you may have heard this repeated over and over for the past 2 years, but today, nobody, not even the most optimistic of investors, are denying this. One quick look at Treasury spreads provides ample evidence that the future looks stormy. The 10-2 spread, which has accurately predicted the last 8 recessions in a row going back to 1961, is now once again flashing red. In fact, the number has gotten so bad that converted into a probability, it now shows a 68% chance of significant economic turmoil in the near term. That's the highest we've seen it since the early 80s, even higher than what we saw in 2007 prior to the great financial crises. Now, away from Treasury spreads, we're also seeing growing evidence in other indexes that trouble is ahead. The Empire Manufacturing Index, one of the most reliable surveys regarding the health of manufacturing, unexpectedly collapsed more than 42 points in one of the worst misses ever. Outside of the lockdown era, this is the single biggest month-over-month drop in history. New orders also fell near record lows, indicating that the coming recession may be far from mild. Along with this, we have various first-hand accounts by business leaders across the country screaming that the golden period is over, and while we have yet to feel the effects firsthand, many economists are in agreement that 2024 will be ugly. So with that information, how do we model what is going to happen in a future housing crash? Well, to begin, we start with a simple base. We know that in order for prices to come down significantly, we need inventory to rise significantly. Specifically, we would like to see this number, the number of single-family homes for sale, go from today's count of 400,000 to the old number of 800,000. At the same time, we would want to see rates remain higher than typical, and unemployment would likely have to jump up as well. The sad truth about home price collapses is that they simply cannot happen without some sort of damage to the job market. So with that said, given the information at hand, how do I see it playing out? Well, as we move through the summer, it is true, the market will remain competitive and bubbly, but as the summer cools off, a few important factors will start to change the dynamics of the market. Number one is the Fed. There are a lot of people who think that the Fed will pause with rate hikes for the rest of the year. The market consensus seems to align with this belief, but given Powell's background, I think he's well aware of the implications of an early pause. He understands his duty is to break the back of inflation, and so far he's doing his job exactly as planned. But one wrong move and all of his progress can get wiped away. We saw in the early 80s what can happen when the Fed blinks and the market calls their bluff. Inflation can quickly spring back up if they don't tighten the screws all the way, and there is emerging evidence to suggest that we haven't reached that phase yet. So if Powell raises one more time in 2023 and at the same time the economy turns in Q4 of this year, we're going to have mortgage rates back above 7%. Now, as this economic turmoil gets worse, the unemployment rate will surely tick up. This will cause further demand destruction, and the next phase of the crash will begin. You see, back in the summer of 2022, when the Fed originally began tightening the screws and raising the rates, those massive moves in supply were caused by investors fleeing. Today, we still see that investors make up a significant portion of the market, and while many of them paused their buying spree, almost nobody dumped their active inventory. And this is where I think the next step is: investors capitulating, not just pausing. We know that most people in today's existing homes have mortgages that are well below 5%. In fact, according to most commonly sourced statistics, it's estimated that 80% of active mortgages have a rate below 5%, which means these people are not selling anytime soon, even if prices begin to decline. In order for inventory to move up, the supply will have to come from investors who are still holding on to their houses despite a scare in 2022. When this capitulation phase begins, that's when the crash really starts heating up. Then, once the ball is firmly on the side of the buyers, the true panic begins for sellers. The fall will become self-reinforcing. With little to no demand, offers will dry up. Buyers who are aware of falling prices will do what any rational buyer does: wait. And existing investors will be left to compete via massive price reductions. The spiral will continue until a bottom is met, and the housing crash of 2024 will be the beginning of a long-awaited cycle reversal, one that is 12 years in the making. In the 2008 crash, the national market fell 28% from its peak in 2006 to the bottom in February of 2012. In some local elevated markets like Vegas, for example, prices fell as much as 60%. Given these facts, it's fair to say that if the Treasury spreads are correct, the Fed does its duty, and investors do indeed panic as a result, we could get a decline similar in nature to the '08 crash. Now, looking over to Case-Shiller, I would say it would be difficult, if not impossible, to have a crash that takes us back to January 2020 levels. That would require a top-to-bottom crash worse than 2008. With bankruptcies at all-time lows and unemployment as well, this type of crash seems out of touch, but what we can expect is a solid 15 to 20% decline that takes us back to 2021 levels. One that will put the ball on the side of the buyers and allow for a more open buying experience with competition greatly reduced. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and don't forget to leave a comment letting me know what you think about the prediction and what you're seeing in the markets around you.